Along with the flow of goods and services between countries, there's also the flow of capital, of finance. And so one of the things that's important to keep track of is how money is flowing between countries. And one of the ways we do that is by looking at the balance of payments. And so if we think about the balance of payments, if we only traded uh, money, currencies, because we traded goods and services, then all of the exports we sent from one country would be balanced by all of the imports we bought from another country. But of course, that doesn't always happen, right? Some countries have a trade deficit, some have a trade surplus. And so what we look at is both the exports and imports, but also the net investment. And that can be portfolio investment, right? So the buying of foreign stocks or bonds. It could be U.S. Investors buying Japanese bonds or German stocks, or it could be Chinese investors buying U.S. stocks and bonds. Or it could be foreign direct investment. What we mean by foreign direct investment is the actual ownership of physical assets. And so it could be, U.S. owning a factory in China, the Japanese owning a building in the U.S., whatever that is. And so we can look at the current account, which is the trade balance, the exports minus imports, and then plus net investment. So that investment balanced out between countries. So all of the investment from the U.S. to Japan, say, and then from Japan to the U.S. And so if we have a current account deficit, then the country is borrowing. They're receiving net capital flows. So if that number is negative, and if we have a current account surplus, then the country is lending, right? It's a net capital outflow. And so what we've seen in terms of globalization, that as we've had an increase in trade and goods and services, that we also get an increase in the flow of capital. And so on this left-hand side graph, we have the average absolute current account balances, right? So some will be negative and some will be positive, but we're just taking the absolute as a percentage of GDP, and this is for 15 sort of industrialized countries. And you can see it was really high in that first period of globalization. It fell during that deglobalization period, and then rose again during sort of the globalization 2 period. And then here we have, assets divided by sort of an average GDP, and you can see that that is increasing as well. And so the current account imbalances tend to increase as trade increases. And so some countries are borrowing more, some countries are lending more. And that those international asset holdings, so, US holding assets abroad, other countries holding US assets, has increased over the 20th century. So if we look at, for example, the United States, this is U.S. Foreign direct investment, and we can see that in most of U.S. foreign direct investment goes to Europe. So these are countries with manufacturing wages higher than the U.S., and these are countries with manufacturing wages lower than the U.S. And a lot of the focus has been on places like Latin America and China and other parts of Asia, but the majority of foreign direct investment actually goes to countries like the UK, Germany, Luxembourg, the Netherlands, etc. Finally, the last piece we want to think about in terms of globalization is the integration of labor markets. And so, the US has always had a lot more immigration uh, to our country than other countries have. This measures the immigration to the U.S. as a percentage of the increase in population. So if it's 0, that means that all of the increase in population is from just native-born people having more children. If it's 100%, then it's more. It's almost all immigration. And so you can see, throughout the 19th century, between 30 and 50% of the increase in the population was due to immigration. That fell off a bit in the late 19th century. Um, so there was problems in European farming, but we also started putting in restrictions first against Chinese immigrants, and then in the 1920s we started putting in more restrictive immigration laws. And so those laws sort of decreased immigration significantly until about 1965, where we opened up our borders again, and it increased substantially, although it has fallen off since the 80s and 90s. And over here, we can sort of see manufacturing wages relative to the U.S. So the U.S. is 100, and of course, manufacturing wages have been going up over this time frame. So this is 1975, 79, this is 2012. And you can see that most countries have been increasing. So some are actually significantly higher than the US. So that's Norway, Sweden, Germany. France is a little bit higher than the US. And then other countries are sort of catching up: UK, Japan, Italy. Um, the only country that's really sort of seen wages go down relative to the US is Mexico. Um, but there are still significant wage differences, right? And that's due to the fact that there are, immigration barriers. Not everybody, wants to move to a different country. And even if they want to move, they aren't always able to. So we still see, manufacturing wages ranging from, very, very little compared to the US and Sri Lanka. Others, 20%, 40%, and in Norway even 80% higher compared to the US.